Today's webinar is the second installment of our series on financial planning for young alumni. A recording of the first installment is available on the RIT Alumni Association YouTube page. Our presenter is Joe Boyd, an RIT Chemistry alumnus from the class of 2004 and Vice President and Financial Advisor at Brighton Securities, an independently owned financial services firm serving clients in Rochester and around the country for more than 40 years. Following his time as a QA/QC chemist and project engineer, Joe has been in the financial services industry for 7 years, 6 years of which have been with Brighton Securities. As a scientist by training, Joe applies a data-driven, detailed, and thoughtful approach to financial advising. He specializes in critically analyzing complex client information, researching various strategies, and making recommendations to clients that are designed to help them address their specific needs. He wants his clients to know not only what investments they have, but also why they have them. Joe is a valued volunteer at RIT and has frequented RIT Alumni Chapter events. He lives in the Victor area with his wife, Becca, and values his family time with their son, Aaron, and daughter, Elodie. Joe, take it away.
Thank you very much, Lydia, and thank you everybody who's taken the time out of your busy days to join us. If anybody has joined us on the previous webinar, you'll understand that, I really mean that because everyone's time is very valuable. And again, time is more valuable than money. So I appreciate the time that you're spending with us to learn, and hopefully you can learn a lot from today's presentation. So this segment will talk more in depth about the financial planning things. The first webinar we touched on some of the basics of budgeting and things like that. We'll go more in depth into different saving strategies, talk about more on the planning side, and then answer any questions that anybody has. If you were with us with the first webinar, you'll realize that I don't put a lot of content in the webinars necessarily, just because I have a personal problem of inundating people with too much information, and I'd much rather allow the participants to help drive the conversation as well. So with that, feel free to let us know if you have any questions, and let's keep this interactive as much as possible. Thank you. So going back to my chemistry days, one of the things that we talked about was controlling a process or controlling the equipment that you use, and the only way that you can control it is by having a plan and continuously measuring how things are working. And so using that process approach to financial services, to me, it just makes sense. And again, having a plan just makes it a lot easier for you to identify where you are today, where you want to be tomorrow, and then coming up with a plan on how to get there. Some of the topics that we'll cover today is, some roadblocks to success for a lot of people, marking your location of where you're starting from, how to figure out where you want to go, and then some rules of the road on how to get there. So some of the roadblocks to success, one is something called inflation. And the thing about inflation is you can't touch it, you can't smell it, you can't taste it. You kind of feel it when you go to buy a gallon of gas or a movie ticket or a loaf of bread, whatever it might be. I know that I've definitely experienced that with my grocery bills. But to give you an example, from 1983 to 2013, over that 20-year time period, gasoline went from 55 cents to $1.39. Now, we know that recently, I think back around 2008, 2009, gas went up as high as, almost $4 a gallon is what I remember, and now we're right around $2.20 a gallon. But just that over that 20-year time period, the average rate of inflation was 3.14% compound. That was for a loaf of bread. For regular gasoline, in 83 it was $1.23, it went up to 3.28. That's an average inflation rate of 3.32%. A movie ticket, and I think this is even low in regards to today's standards. And the reason why I don't know that is, frankly, I don't go see a lot of movies. The average inflation rate has been 3.2%. So for a lot of people that I work with, one of the things that we always have to take into account in the planning is inflation. And the way I put it is giving yourself a raise each year in retirement to keep up with inflation. Taxes. Taxes are another thing that, you can't really taste, but you feel, I guess, when you get your paycheck and things like that. And at the end of the day, when you look at your investments and are planning for your for whatever financial goals that you have, you need to take into account taxes and how they affect your investment returns, because it's not how much you make as much as how much you get to keep at the end of the day as well. And then last but not least, I think a lot of us are guilty of it, and from recent experiences, Lydia will probably attest that I also have a problem with this, is procrastination. And procrastination to the sense that, we're all so busy, and for a lot of you that may be joining us today who may be on the younger side, you think that you're busy now. I hate to break it to you, but it only gets busier. Life, you would think, might get simpler as time goes on, but it only gets more complicated, and procrastination becomes more and more prevalent in your daily activities. And what this chart is trying to illustrate is that obviously the earlier that you start, and I touched on this at the first webinar, the higher likelihood of you achieving your financial goals, because again, the time that you have, the compounding of the growth over that time period, because in the beginning, for the first 10, 15 years, when you have compound growth on a lower, more modest dollar amount, the effect isn't as significant. It's not until you get to the 20-plus year time period and you're compounding now on hundreds of thousands of dollars or even millions of dollars that the compounding really has an impact and an effect. So if we can make sure that we're planning to stay ahead of inflation, or at the very least keeping up with inflation, that we're going about this in a tax-efficient manner and keep an eye on what we get to keep at the end of everything is said and done, and keeping ourselves from procrastination. And again, this is the pot calling the kettle black. These are some of the roadblocks that if you can overcome, these simple things will help you get to your success a lot quicker than if you fall prey to any of these. So marketing location, where are you today? How much do you have saved in your savings account? How much do you have in your 401k? How much do you have in outside investments? Do you have a house? Are you renting? Getting an assessment, and I talked a little about this at the last webinar, or a net worth statement of what kind of assets that you have to start with is how you figure out, where am I starting from. From there, the different vehicles or accounts that you might have available to you to help save for your various financial goals. A lot of people should have access to a 401k plan. Some people, depending on who their employer are, so I have clients with Boeing, they have an employer stock purchase plan here locally. Constellation Brands has a nice employer stock purchase plan. My pharmacy clients at CVS, they have a nice employer stock purchase plan. If you have something like that available to you, I would highly recommend that you read into it, look at what the rules are, how it works, how you can participate. Because over the long term, if you have confidence in your company and you're contributing to the bottom line and the future success of your company, that is a fantastic way to be able to accumulate shares of a public stock at a discount. And what I mean by that is, I don't think I'm giving away any confidential information, but for CVS, for my clients, in a given 6-month time period, and for Constellation Brands, I believe, they take the stock price, let's say it's January 1, and whatever it is on June 31st, within that 6-month time period, whatever the lower price is, you can buy shares at a 15% discount to whatever that lower price is. So essentially, you're able to instantly make 15% appreciation through that employer stock purchase plan. And now there are some rules and how long you need to hold those shares, and then obviously you're going to have to pay taxes on gains and things like that at some point. But if you have something like that available to you, that's something that I highly recommend looking into. For those that do not have a 401k plan, you can put money into a traditional IRA and have that be deductible. If you participate or have the option to participate in an employer-sponsored retirement plan like a 401k, or if you work at RIT, a 403b, or not-for-profit, or if you work in the public sector, a 457 deferred comp, you can put money into a traditional IRA, but it will not be deductible. So then you might want to consider putting money into a Roth IRA where it's after-tax money, but that'll grow for you tax-free, and the gains and growth will come out tax-free as long as you have it for 5 years and after 59.5. And so there's a lot of rules of like if, then that, but not this. So again, if you have any questions on some clarifications of your personal situation, feel free to contact me or work with your personal financial advisor if you have one to get an idea of, okay, based on my situation, what are some strategies that I personally can take advantage of. And for the next one, I seem to have deleted the P in personal investment plans. But for those who are maxing out their 401ks, if you're under 50, that's $18,000 a year. If you put, whatever you can contribute into your employee stock purchase plan, if you have that available to you, if you're maxing out your Roth IRA, $5,500 a year, then really the money that you have left over is after-tax savings of building a brokerage account and putting money into that on a regular basis. And I do have a fair number of clients that I encourage to do this because if it's sitting in a savings account, that's a 100% guaranteed way to lose money over the long run because you're losing money to inflation. So if we use those previous examples in the slide earlier, you're losing about 3% each year in purchasing power, whether you realize it or not. And again, this is over the long term. It's not, in any given day or month or even year for that matter, because, food and gas prices and other prices of goods can go up and down over time. But over the long term, having money just sit in a savings account or having too much money sit in a savings account or a CD is, especially in these low interest rate environments, is a guaranteed way to lose money and not give yourself a chance to even keep up with inflation. So setting up an investment plan on a monthly contribution basis, similar to a Roth IRA or a 401k, is a nice way to pay yourself first, to get used to having that deduction from your spending, what's available to you for spending, and then after that, knowing that whatever you have left over is you can spend on whatever you want is very nice.
Joe, can we just get a clarification? We have a question here as to whether or not the employee stock purchase plan is the purchase price usually the lower of 2 dates or the lowest throughout the period?
Typically, it's the lower of the two prices within a 6-month time period. So I'm just using Jan 1 through June 30th or 31st, I think June 30th, as examples of a 6-month time period. So whatever the stock price is at the end of January 1st and at the end of June 30th, whatever the lower one is. So let's say for Constellation Brands, if it's $100 as of June 30th, but it was $75 as of Jan 1, then it would be a 15% discount for Constellation Brands' employees. It's a 15% discount to the $75. And so if it's trading at $100 now, then obviously you're getting even greater discount to what the typical investor is able to get those stock shares at. And again, it's a great benefit, but this is all after-tax money, and there will be long-term capital gains taxes, and you may have to pay taxes on the difference as well, because a lot of clients also get stock options from employers. I have clients at both of those companies that get stock options if you're kind of a higher manager, middle manager, upper management, where they have rules as well. But yes, to clarify, it's typically, from what I've read of the different stock purchase plans, it's the lower of the two prices within a 6-month time period, and then it resets for the next 6 months. So preparing for your journey, so like I mentioned before, coming up with what are your goals. A lot of people, if you have children, especially if they're young children, a lot of clients always ask me, well, what's the best way to save for college for my children? And it's, for those that joined us in the previous webinar, you're going to consistently hear me say, well, it depends. It depends on your situation. It depends on what your priorities are. If you think that if you want to fund 100%, then, identifying what potential colleges that they might be applying to. And I know these are all hard things because it's such a long time away. But using a college like RIT, if they went to RIT, or another school if they went to another school, and using those real actual costs of today, and then keeping up with what they increase over time, those are all factors that need to come into play. But if you're not putting money into a Roth IRA, my recommendation is to max out the Roth IRA as a college savings vehicle before doing a 529 plan, because again, you have the short-term and medium-term liquidity benefits with a Roth IRA, and if your child is a star athlete or an academic all-star, then they might qualify for financial aid and scholarships or grants that can reduce the amount that you need. And now you've got this money tied up in a 529 plan that you may have to pay taxes on, for any gains, but there's not a perfect tool for everybody. It's going to come down to what your capabilities and abilities are. So for my personal situation, just to share with everybody, I guess as an example, after I max out my 401k, max out an IRA for my wife because she stays at home, and so we're able to deduct that, and the Roth IRA for myself, then we put excess money into a 529 for our children. And then for gifts from grandparents and things like that, or parents, putting money into a 529 plan, I like to do just so that they know that it's going into a 529 plan versus a Roth IRA in my name or my wife's name or something like that.
Joe, quick question on 529s to clarify. What college expenses can be covered with the money coming out of a 529 plan?
So you always want to confirm with each state, because these are more state-driven than anything. But typically what we see is any expenses associated with higher education, so room and board, books, computers, if that's kind of a requirement, which I would argue is considered a requirement. Obviously tuition, fees and expenses related to college and things like that. I would argue that you may not be able to get away with like a car, but pretty much any of the expenses that you've experienced that you had in school would qualify for a 529 plan as a qualified expense.
I'm sorry, and then we have one other question. The participant says that they used to contribute to a 401k until the employer match was met, and then put money into a Roth IRA. They say they can no longer contribute to a Roth IRA. They still do their 401k. Is it the best fit then to go directly into a 529 for their son?
So this is a great question and a great problem to have. So if you can't contribute into a Roth IRA, it means that you exceed the IRA contribution limits due to your income. Depending on if you have an IRA, okay, if you do not have a traditional IRA, what you could do is put money into an IRA, and so those would be non-deductible contributions, essentially being after-tax money. Then you can immediately convert it into a Roth IRA, because a handful of years ago, 4, 5, 6 years ago, the law was changed where income limits no longer constrained those who could convert money from an IRA to a Roth IRA, and that's kind of what's called a backdoor method of funding a Roth IRA if you exceed the income limits. So if you're maxing out your contribution to your 401k based on you're getting the full match from your company, then the next step would be taking the money that you would have put into a Roth IRA into a traditional IRA as a non-deductible contribution, and then converting it into your Roth IRA. But if you're doing your own taxes, depending on how confident you feel about, accounting for all that in your taxes, because you do need to account for it, it could get a little complicated, and so if you want some further guidance on that, feel free to reach out to me, or again, talk to your personal financial advisor, or talk to your tax preparer as well. If you're doing it through like TurboTax, I've come across instances where clients have had a little issue with that, but if you are in a higher income bracket and you have these more sophisticated challenges, then I'm going to presume that you probably are using an accountant as well to kind of help minimize the tax bite and try and be as efficient as possible with your tax planning.
And one other really good question on 529s, what happens if your child doesn't go to college?
So that's what I mentioned earlier is if it doesn't go to college, the money that was contributed, so that's kind of called your basis, that you can always take out without penalty or taxes because you're just taking money out that you put in. It's the growth that you would have to pay taxes on. And for some reason, off the top of my head, I can't, if you just take it out. But if you actually use the money for something else, there is a penalty as well. So you'll have to excuse me for the brain maps right now, but you could always Google the exact rules for your state-specific 529 plan if you would incur a tax penalty as well, or just pay the taxes on the growth of the 529 plan. The other thing that I didn't really touch on as much is, going back to the inflation rate or increase in cost for college education. There's a lot of you who went to RIT probably experienced, and me being I guess I thought that I was a recent grad, but looking back, I guess I'm really not. The only thing exceeding the increasing costs of healthcare is higher education. So I think a lot of us Hello? Can everybody hear us now?
Yes. That momentary pause was brought to you by RIT. I apologize, everyone. We did lose audio for a minute there, but I think we are back in. I think we had some kind of a WebEx issue here. So we were talking about 529 and the tax implications if you do not use the money if your child does not attend college or does not use all of the money that's in the 529.
Right. And the thing I think when we got dropped off was, and for how much you will need, again, higher education costs is the one thing that's exceeding the pace of inflation of healthcare costs. So healthcare costs I know are going up high single, low double digits, maybe even mid double digits in some, teens area for some people. And higher education costs, good or bad, are exceeding those growth paces. So I guess what I would say is to temper people's expectations, save what you can, but don't feel bad if you can't save everything unless you have really generous relatives. Retirement or financial independence needs, how much will you need? A good way that I like to approach this is, if by going through the whole budgeting process with my clients, understanding what their monthly expenses are, using that as a starting point in today's dollars and then calculating a compound annual growth rate between now and retirement so that I know what they want to be able to spend on an after-tax basis is how you come up to that number. So the calculations should be fairly simple, but if you don't know the formulas to use or you'd like some, I guess, actual formulas, feel free to reach out to me via email or telephone call, and I can help talk you through it. Or at the very least, you know, work with your financial advisor to kind of help you out with that if you're not good at math or don't want to do that on your own. But starting off, again, by understanding how much you need today, how much you're spending today, and then understanding what you're going to need in the future is helps you calculate what lump sum that you should have. And you know, a lot of people always say, well, when I retire, I won't have my house expense, and I won't be doing this, and I won't be doing that. And I say that's a fair argument. But what a lot of people don't appreciate is how much that they'll spend on food, how much that they'll spend on other things that they currently may not be spending on today, especially healthcare, because the older you get, typically the higher your healthcare costs are as well. So we generally do a budget item, a line item for healthcare expenses as well over time. But again, you know, for my clients, I say to them, well, let's at least plan on you living the same quality of life or hopefully higher, because, you know, I don't know why somebody would want to work so hard and so long and save so hard for a comfortable retirement only to take a pay cut, so to speak, and kind of sit and do less. So keep that in mind that, you know, you may think that you're going to spend less if you end up great, but I'd prefer to plan for you spending at least the same amount, hopefully more, because typically people like to travel or do other things that take money. And then last but not least, providing for beneficiaries. You know, what are ways that if you do a great job of accumulating these assets, you know, how will you pass them on in a tax-efficient manner? And, you know, we can go more into depth on that for the next webinar, because the next webinar is focused more on for people who are in like their 50s, 60s, or even in retirement. And
old people like that?
I'd like to put it as seasoned people or experienced people. Because, you know, the more that I guess, the longer that I live, the more that you realize that 60 is kind of like the new 40, you know, I mean, and people are staying more vibrant, people are living a lot longer, and that's another thing, actually, that a lot of people underestimate is their longevity. And a lot of that is influenced by our own personal experiences. So if you've had a loss of a parent, a friend, a relative at a relative early age, sometimes that skews your personal view on how long you're going to live. But the fact of the matter is, you know, because of our medical advances, because of the awareness of taking care of yourself, being more active and a healthier lifestyle, more than likely you will live longer than the generation before you. And the older that you get, I think the more you realize how much you need to start taking care of yourself, so you start eating a lot better and things like that as well. So, you know, how much you need for retirement is also going to be dependent on how long your life expectancy is. So right now, for planning purposes, a lot of my clients, I plan to at least age 95. And a lot of clients will say, if I live that long, I'll be lucky, or, you know, yeah. You know, you don't want to get to that point and go, uh-oh, I didn't plan to live this long and not have enough money. I think you'd rather err on the side of, you know, oh, geez, you know, I was planning on living longer, but now I've got all this, you know, these assets that I can pass on to, you know, other beneficiaries. Yeah. So I may sound like a broken record, and I guess I'm not really apologizing for doing so, but it's the fundamentals, right, of what is your cash flow? How much are you spending today? Balancing your wants and needs of today so that you can afford the needs and wants of tomorrow. And, you know, by having a plan and knowing how much you need to be saving, how that needs to be invested or allocated to give you that growth potential to have that lump sum of money accumulated by the time that you want to retire, and what kind of income that's going to be able to generate. By knowing that, that will give you the confidence and the ability to say, yes, I can spend more for today. So when I get a raise, instead of saying, okay, I should save this, you can feel more confident saying, okay, now I can increase my lifestyle. But if you're going to be increasing your quality of life because you get a raise, a bonus, because you change jobs and you get a nice raise, more than likely you should, again, continue to reassess what your expenses are, because if you're making more money and you start living on more, well, then your plans probably need to adjust upwards as well. So, you know, the previous goal of monthly spending will probably increase as well. So you won't necessarily be able to spend all of that increase, but you should be able to incrementally increase that spending. And by having a plan, by having a control over your expenses and your income and monitoring that on a regular basis will give you that confidence of knowing, you know, what you can afford for the wants above and beyond the needs that you need to pay for today. And again, you know, prioritize what's important to you, right? So if you're somebody who really, really enjoys the, you know, the artisan coffee or the Starbucks and your, you know, lattes, go ahead, spend money on that. But for things that are not as important, that are not a high priority, try and reduce your spending. Right now, I just got a bill for my homeowners and car insurance, and sure enough, my car insurance went up, and you know, the insurance company say it's because insurance rates in New York, this, that, and the other. But I still have gone out in a competitive process to other insurance companies to see what they'll offer me for same coverage for my homeowners and my car insurance. And by doing that, I'm maintaining control over how much my expenses go up. Now, do I need to, you know, per se? No, because I think I can afford the increase, that the 20 bucks, 50 bucks, whatever it is, increase per month. But frankly, I'd rather either save it or use it for a dinner for, you know, my family and I, you know. So keeping track of all that, keeping on top of what those priorities are to you will help you live more for today while still being responsible in saving for tomorrow.
Joe, we have one question for you. Speaking about insurance and the level of insurance we need, what is your thought on having large umbrella policies versus individualized accounts?
Individual in regards, so I guess for umbrella,
homeowners,
right,
car,
okay.
et cetera.
So it's kind of interesting. I think the property and casualty industry is maybe making a big push into umbrella insurance, and I'm not saying that in a good or bad way. I'm just saying that that's what I'm seeing, because I've consistently seen this probably at least every other week, if not every week on average. Somebody talks to me about this, and here's what I've distilled from my conversations with property and casualty insurance companies and brokers. If you have a pool, if you have a business, if you have young children who are driving, where there's a higher level of risk to you of somebody potentially suing you if they slip and fall in your pool, if your child gets into an accident and hurts somebody else, if you have employees that might potentially come back and sue you for whatever it might be, and I hate to, you know, have this come across as a scare tactic, you obviously have more to lose, more assets that people would be trying to come after in the event of a situation where you were getting sued. So an umbrella policy for those types of individuals makes sense. That being said, if you don't have a pool, if you don't have a business, if you don't have young children who are driving, that's going to be a personal decision, right, as to how much protection that you want. And at the end of the day, I've heard that umbrella insurance policies for, I think, like $1 million for me was like 10 bucks a month. So at the end of the day, is it going to break the bank? Am I going to not be able to do something that I want to because I have to pay the umbrella insurance? No, and frankly, you know, from a cost-benefit analysis, it's probably worth it. And for me, because I don't have a pool, because I don't have young children, because I don't technically own a business, even though I have my clients are my own business, but I do have more assets that could be, I guess, come after if something were to happen. Umbrella insurance makes sense, but again, if you're starting off, if you're a young couple, if you don't have a lot of assets or a business or a pool and things like that, you know, you're going to have to evaluate the cost benefit because the younger you are, the less likely that you're going to have discretionary income to be able to afford even, you know, 10, 20 bucks extra a month that you might want to put in your 401k so that you can maximize your company match, you know. So that's, I guess, what I would say about umbrella insurance, but I will confirm that I'm not an expert in property and casualty insurance, only to the extent that I know what I have and what is recommended to me by my insurance broker of what I should have. So definitely talk with your insurance person, and if somebody ever asks you that or recommends that you should have it, you know, just ask why. You know, I think that we don't oftentimes, we don't do what we did as young children, and I know this right now because I'm going through this with my three-year-old, and he's asking why all the time, and it gets kind of annoying from a parent standpoint in answering the question, but it kind of reminds me that, you know, we should be asking why. So when somebody says do this or do that or I need this, you know, just say, well why? You know, just so that I understand better. And so I always ask why to everything, especially with client meetings when they say things, so I can understand where they're coming from and give them a better response as to what I recommend and why. So here's some age-based tips, and typically this is more because of your financial situation. If you're younger than 35, your income is, you know, slowly but surely increasing, hopefully on a regular basis. You're probably paying off things like car loans, student loans. You've got rent or mortgages, and you've got things like you have to you have to furnish your house or your apartment if you want, you know, something nice. And so you have a lot of expenses that are coming up. And so right now your priorities, I would say, is, you know, definitely getting the full match in your 401k and creating a savings bucket above and beyond just reducing the debt that you have. And we talked in the previous webinar about what's considered good debt versus bad debt. And obviously you want to knock down the bad debt first if you have any, and then work on the good debt. But again, you always want to focus on saving, though, for the future, because you want to start saving as early as possible so you can have that compounding growth over the long term of, you know, 30, 40 plus years. Ages 35 to 50, typically your income is increasing more now, and you're hitting your prime earning years, the early part of your prime earning years. And you do have more expenses, but again, because of the income, hopefully will be enough to meet those increasing expenses. You're able to accumulate more in your investments and save more into your 401k or max out your IRA or Roth IRA and start saving into an individual investment account. Also, you know, your insurance costs may go up because of things like umbrella insurance, or because you have an extra car, or, you know, two. Because you have a bigger house, and, you know, things like college funding start coming into play, especially, I mean, I guess this is kind of more appropriate for me. I got married at 35 and started having children, you know, shortly thereafter, so college funding was started then as opposed to starting when I was in my 20s and, you know, children weren't really top of mind. And from what I'm reading, household formation is kind of happening later and later. And for whatever reason, especially among the millennials, it's happening later and later, where people are just getting married later, and probably a lot of it could be because they feel they need to pay down their student loans or get out of debt before taking on that added responsibility of a marriage and children. But that's kind of like the next phase. And then once you hit 50 or even closer to 60, typically that's when the children are out of school, out of high school, out of college, and now you hit the area where a lot of clients say, and believe it or not, they say, I've got too much money, I don't know what to do with all this money, and that's when they really try to ramp up their savings for retirement. The unfortunate thing is, though, that they don't have as much time now until retirement and for that money to grow over the long term, so they need to save a lot more to, if they want to, if they have larger retirement goals and financial goals as well. But by age 50, you probably have very minimal debts, if any, other than maybe a mortgage, and you've got more in investments, whether it be in your 401k and IRA, because you've switched jobs a handful of times. And again, your insurance, your health care becomes more of a priority, and looking at things like long-term care, which for a lot of you on this webinar probably isn't even something to worry about right now. But all those parts and pieces go towards helping you preserve, protect, and pass on what you've accumulated and worked so hard for. So those are some different phases that you can expect as you go through, and if you can obviously reduce your expenses earlier than age 35, or have a good situation where your income far exceeds your expenses, then you can get ahead of things. But just having that plan and figuring out, okay, how much do I need to be saving? What are my retirement goals? That will go a long way in making sure that you stay on track. And again, these are just tips. These are guidelines. This is not to apply to everybody. If you were with us in the first webinar, you'll hear me say everybody is unique. Everybody's situation is different. So what applies to one person may not apply to everybody else. So you really need to have a customized solution or plan for yourself, because your priorities are different than everyone else's. This is an example of a page of a report for the financial plans that we have for our clients that show us kind of a upper limit and lower limit, confidence limit of their plan as they move on through the saving accumulation years. And what that shows is, as long as your investments are within that upper and lower confidence limit, you're doing okay. You're balancing today for tomorrow. You're giving yourself a 75 to 90% confidence that you won't run out of money. In school, we always strive to get those A's and hundreds, and that's good for education. But when it comes to retirement planning, if you score above a 90 or 100 percentile, what it means is you're sacrificing a little of today to have a more certain tomorrow, or based on what you've accumulated and what you're saving, your retirement goals tomorrow are too conservative based on what you have accumulated. So you may want to either increase your retirement expectations, whether it be retiring earlier or just retiring at the same time that you want to, but just spending a lot more, or saving less today, so that, again, you're balancing today and for tomorrow, because there's no guarantee for tomorrow. And that's what our plans provide our clients. But some of the rules to, again, think about is always pay yourself first in the form of saving your 401k, an IRA if you don't have the ability to do a 401k or a Roth IRA, and then making sure that you pay off your other bills and expenses, and then what's left over, that's what you can use for going out to dinner, shopping for clothes, whatever people want to do nowadays. Also making educated investment choices, so one of the questions that people always ask is it better to lease or buy? And, I'm going to always fall back to it depends. Some people need to have that newest technology, the newest features in a car, and they, for whatever reason, don't want to have a car for more than 2 or 3 years. And in that case, leasing is a good option, because you're really only paying for what you're using, both from a tax perspective and a payment perspective. But if you're somebody who, doesn't care what they drive, doesn't need to have the latest technology, and understands that a car is ultimately just a depreciating asset, so to speak, that you just continue to put money into for gas, upkeep and things like that, and you plan on having that car until it breaks down on you in 10, 15 plus years, if you take good care of it, then buying is definitely a better option, because once you've no longer made those payments, now you've got that money that you can reallocate to something else, whether it be saving or spending, and again, that's going to depend on your plan. Another thing is asset allocation. So in the previous webinar, I told people that asset allocation is our industry's fancy way of making ourselves feel smart and talk, and that's a way of saying diversification. How are you diversified between stocks and bonds? And then within those categories or subcategories of short-term bonds, intermediate-term bonds, long-term bonds, high-yield bonds, emerging market bonds, And then within stocks, there's, big companies, medium companies, small companies, or large cap, small cap, mid cap, international, emerging market as well, investments, and how you are diversified in percentages among all those different asset classes or sectors or sleeves, whatever you want to call it, is, will give you the ability to hopefully put together an efficient portfolio where you're trying to maximize the return but reduce the risk by using those risk-return characteristics and utilizing non-correlating characteristics so that not everything goes up or everything goes down together. And so understanding how much horsepower or growth that you need over the given time period between now and your retirement will help determine how your asset allocation is for your different investment accounts. And then understanding asset location, kind of coming back to the tax slide in the beginning. Some investments are more tax efficient, so individual stocks are fairly tax efficient because if you plan on buying it, holding it over the long term, if you hold it for more than a year, their long-term capital gains are taxed currently at 15% rate, whereas short-term capital gains less than a year are taxed at your marginal tax bracket. So if you're 25, 30, 40% tax bracket, then you probably want to keep that in mind if you're going to take a short-term gain. Also, if you're in the 10 or 15% tax bracket currently, and whether you're working or in retirement, a benefit that you have is that long-term capital gains are taxed at 0%. So for some of my clients who have a lot in investment savings but don't have a lot of income that they show other than savings, from Social Security, we can be more efficient with individual stocks in a brokerage account because if they hold it for more than a year, they won't pay any taxes on it. Also, things like interest income from bonds. How is that taxed versus mutual funds? Because with mutual funds, they're a little less tax efficient, whether it be passive or actively managed mutual funds. They're a little less tax efficient because you yourself don't have control over when that mutual fund manager realizes profits on a given investment. And so on a quarterly but mostly semi-annual basis, you'll see long and short-term capital gains get passed on to you if you own mutual funds. And by having those more growth type investments in qualified accounts like a Roth IRA, traditional IRA, or a 401k, it makes more sense to have active managed funds in those as well. Also, if you have the good problem of you're a very high income earner and you have a high tax bracket, tax deferral in an annuity might make sense. And that's another whole topic that I'll probably touch on more in the third webinar. But there's a lot of costs associated with annuities, and so you have to evaluate on a net of cost basis. Am I ahead of the game because the cost is lower than the tax that I would incur or the benefit that I get from tax deferral? And so understanding asset location is also a way to squeeze out some extra, more efficient tax returns for yourself in your given investments that you have. And again, get an advisor, whether you have a personal advisor, and there's a lot of ways that you can work with an advisor. One is a commission-based, where they'll charge you based on recommendations that you buy or sell, or a fee-based, or a fee-only advisor, where they'll just meet with you, charge you a fee on an hourly basis or annual basis to just meet with you a couple times a year, 4 times a year to put together a plan for you and things like that. Again, the more moving parts that you have, I would definitely encourage you to seek an advisor, because I'm pretty certain that if you're in that situation, you're pretty successful because you're pretty good at what you do. And at the end of the day, the cost that you have for an accountant, for an advisor, for an attorney will definitely should benefit you over the long term versus you trying to do everything on your own. And again, the older you get, the better off that you are in your respective field, the less time that you're going to have, especially if you have family and children and things like that.
Joe, quick question. What is a managed account? Who does it work for, and what's the advantage? Sure, that's a great question. So a managed account is typically, there's 2 ways. So
You can do a managed account where the advisor or the money manager has discretion and they charge you a fee. So let's just, for the sake of argument, use 1%, okay? So they might charge you 1% to manage your IRA, and you pay a quarterly fee, you know, so a quarter percentage point each quarter to get to have that management. If it's a discretionary managed account, then they do not call you. You don't have discretion, or the advisor or money manager has 100% discretion in what they buy or sell. In a non-discretionary managed account, then I, as a financial advisor, have to call the client every time that I want to buy or sell something. And then the client has their feedback of, okay, you know, you can ask questions of, well, why do you think there's an opportunity, or what do you think the upside is, or what's the downside, and you're more involved. And again, if you're really busy and you don't want to be involved and you just trust the person that you're working with, then a discretionary is a good way to go. If you want to be more involved, then a non-discretion managed account is a better way to go. The reason for a managed account and why it might make sense for some people is it structurally aligns the advisor's incentives and your objectives on the same side of the table, because the only way that they're going to make more money is if the value of your account goes up. Conversely, if the value of the account goes down that next quarter, then their fee that you pay them goes down as well. So it does remove the question of is this in my best interest, or are they recommending this because it's in the advisor's best interest because they're going to make a commission or they're going to get paid on it. So that's a benefit there. Also, with the managed accounts, you have more protections from a legal perspective. If you look at any paperwork, there's something called arbitration, where you agree that before you sue the advisor or the investment firm, you will go to arbitration beforehand. And through arbitration, you have the ability to make your case, the advisor and the firm gets to make their case as to who is right or wrong, and then they you know, come up with a ruling. And if the arbitration says, oh, geez, you know, the advisor really was not looking in your best interest through this advisory account, then, you know, then you can sue for damages. If it's that, you know, it's shown that they did do everything in the best interest of your best interest, but for whatever reason the investments didn't work out, you know, then you may have less of an argument moving forward. But at the same time, if you have an investment portfolio of good mutual funds with great individual stocks, and you don't want to do a lot of transactions because you want to be like Warren Buffett and buy and hold for the most part, then, you know, I would argue advisory may not be the best way to go, because, you know, just pay as you go. So as you buy something or sell something, that may be more cost effective for you. And at the end of the day, if you are working with a financial advisor that is reputable and that you trust, you know, they should still be looking out for your best interest, because especially here in Rochester, you know, it's a real small, it's a big city, but it's a small town feel, because whoever you meet, invariably, after you know, a while talking, you'll be able to connect people, mutual people that you know. And so, if you know, if I do a bad job, or if I you know, do unethical things with clients and recommendations to clients, then that will get around fairly quickly, and I won't have a long career here in this business. So those are some pros and cons to both. And again, when somebody recommends a managed account, ask why. Why for me does this make sense? What is my benefit? Why do you think that, you know, this is better versus another strategy? And if they're able to give you an answer that makes you feel good and confident of, okay, yeah, that makes sense, then that's the way to go. And again, it's not always about investment results, right? Because a lot of times when I give, and I had an example this morning when I was talking with a client, in giving them recommendations of when her and her husband should take Social Security, right? By giving them the information on how to make the best decision to maximize Social Security, that increases value in how much extra money they're able to get out of Social Security based on their specific situation. When I have other clients that are have multiple mortgages, and for whatever reason, because of their situation, it may make sense to consolidate all those mortgages and refinance, even net of costs, and them saving $32,000 over the next 5 years in their mortgage. That's real value. Now, whether those clients decide to move forward with it, that's ultimately their decision, but part of the advisory fee that I'm getting paid for is the advice of how to maximize and be most efficient about their financial decisions. We're getting close to the end, and I think we're pretty much done. I appreciate everybody staying on the line and spending time with us this afternoon. Thank you.
Okay. We got one last question that we'll cover, and that is for the people under 50. Is there an advantage to getting into a long-term care plan earlier?
I would say, for the most part, no, unless there is like a strong hereditary prevalence of things like Alzheimer's or diabetes, or something where ultimately you might need long-term care. Even that being said, during the underwriting process, it could be a red flag where an insurance company goes, why is this 35-year-old looking for long-term care insurance? And with most insurance, the earlier you get it, the cheaper it is, so you could use that argument. But, a lot of my clients, again, the cost benefit really doesn't make sense until you get closer to at least 45, 50 years old. But I'm not going to say that you shouldn't if that's something that's really important to you. And again, this comes down to what are your priorities. And if you've seen and experienced in your life where a parent or a relative has had to have long-term care, or even multiple relatives and friends have seen that, then that will be more on your radar and be a higher priority. So that's what I would say to that is, because that's an added cost, and until you can afford that added cost, and again, that you're saving and taking care of all those other fundamental needs, then that's when I would say, if you have extra money that you want to spend and it's really important to you, then yeah,